Are US companies required to withhold Canadian payroll taxes? A US company paying someone who lives and works in Canada is not just writing a cross-border check. In many cases, it is acting as an employer in the Canadian sense and is expected to withhold Canadian tax and social contributions from the pay. The fact that the company is headquartered outside Canada does not exempt it from being part of Canada's system of source deductions. The core question is whether the payments you are making are Canadian employment income. If they are, Canada expects withholding at source unless a specific exception applies and has been properly documented. Employment income earned in Canada. From a Canadian perspective, employment income is taxed based on where the work is performed and where the employee is resident. A Canadian resident working in Canada for a US company is typically earning Canadian employment income. Paying that worker exclusively through a US payroll system does not change the source of the income. In that situation, Canadian rules generally require the payer to withhold income tax, Canada Pension Plan contributions where applicable, and employment insurance premiums, and to remit those amounts to the Canadian authorities. The payer is treated as an employer for Canadian purposes even if it has no bricks and mortar presence in Canada. Short-term assignments and treaty relief. There are narrow situations where employment income earned in Canada is exempt from Canadian tax under treaty rules, especially when the employee is not resident in Canada and spends only limited time there, and when other conditions about who bears the cost and where the employer is resident are met. In those cases, it may be possible for a US company not to withhold Canadian income tax on that income. However, relying on treaty relief usually involves more than a casual assumption. It often requires careful tracking of days worked in Canada, analysis of where the economic employer really sits, and in some situations, formal waivers or approvals. If you intend to rely on treaty-based exemptions to avoid withholding, it should be an explicit, documented strategy, not an accident. CPP, EI, and Social Security coordination. Even when treaty rules affect income tax withholding, social contributions can behave differently. Canada Pension Plan and employment insurance apply based on specific criteria that can intersect with international social security agreements. There are scenarios where an employee remains covered by US Social Security for a period and is exempt from CPP, but that usually requires a certificate of coverage from the US side and careful alignment between the two systems. The important point is that withholding obligations are not just about income tax. They often include mandatory contributions that require the employer to register, calculate both employee and employer portions, and remit them alongside tax. Contractor versus employee labels. US companies sometimes try to avoid withholding by treating people in Canada as independent contractors. If the relationship is genuinely an arm's-length business relationship where the worker runs their own business, bears risk, controls their work, and invoices for services, they are usually responsible for their own tax and social contributions. In that case, the US company does not withhold Canadian payroll taxes. If the relationship looks like employment with set hours, ongoing control, integration into the company's structure, and little risk to the worker, Canadian authorities can reclassify the person as an employee. When that happens, the company can be held liable for unremitted withholding and employer contributions, even if the worker has been paying their own tax. Permanent establishment is not the gatekeeper. A US company does not need a permanent establishment in Canada before it has to withhold Canadian payroll taxes. Permanent establishment is about corporate income tax and how business profits are allocated between countries. Payroll withholding is about making sure employment income that Canada has the right to tax is taxed appropriately. A foreign employer can be required to withhold on Canadian employment income even when it has no permanent establishment and even if the corporate income is not taxable in Canada. That is often the most surprising aspect for US owners because they are used to thinking of obligations only in terms of corporate presence. Canada separates the employment question from the corporate profit question. What happens if you do not withhold? If you should have withheld and did not, the tax authority can assess the employer for the amounts that should have been remitted, plus interest and penalties. The fact that the employee eventually paid their own tax does not necessarily remove the employer's exposure because the withholding rules are enforced independently. For cross-border employers, that means ignoring withholding is a risky way to handle Canadian workers. It may appear to work for a while, but the exposure can surface years later in an audit or when the employee's tax filings are reviewed. Final thoughts. U.S. companies are often required to withhold Canadian payroll taxes when they pay Canadian employment income, even if they are not incorporated in Canada and have no traditional presence there. Exceptions exist, particularly for short-term assignments covered by treaty rules, but they are not default settings. They have to be earned and documented. If you are paying people in Canada and not currently withholding anything for Canadian authorities, it is worth revisiting that decision before relationships become long-term and amounts become large. For more plain language guidance like this, you can visit www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.